Will it be a great year for chemicals? Will it be a great year for soda ash? Are we at a breakthrough in terms of what Tata Chemical is trying to attempt in terms of an breakout technology for battery? Will operating leverage and financial leverage kick in for Tata Chemicals? I think these are very pertinent questions, and I'll take the liberty of throwing them directly to Mr. R. Mukundan, Managing Director and CEO of Tata Chemicals. Mr. Mukundan, good morning. Thank you for joining us. Let's first start with your outlook for 2025 for, let's say, the chemical sector and soda ash in particular, because that in a sense is your main commodity. Do you expect 2025 to be better than 2024, or it could be on similar lines?
So, Nikunj, firstly, I just want to say that I was hearing to what Ajay was saying in the previous section. Let me just connect and lead into the question you're asking. Really, I think internationally, I think we are very clear that Tata Chemicals is present in two key markets. One is India and US. I think these are the best markets to be in today. I think despite what was said about deficit and every other element, we think extremely positively about India, and we are very, very bullish about investing, continuing to invest in India, and so in US. So I think let me just say that if you want to put your money, bet your money, I think these are two markets we would certainly be betting money on the table. Second, as far as we are concerned, we have clearly highlighted that our first step of the expansion, which was about 250,000 ton, is already in operation today. And we are adding another 1,000,000 ton, and of which it's going to come in basically three broad locations: India, Kenya, and US. US being the larger chunk, 400,000 ton, and the balance split equally between India and Kenya, 300,000 ton. And that's been cleared by the board, and we are going to go ahead with that investment in a phased manner. As and when we take specific approvals, we'll come back and announce the market. But this 1,000,000 ton is pretty much in the pocket. And there's a huge operating leverage because we really are not going to be adding any fixed cost as we bring that to the market. And market is growing on the back of two broad drivers. Let me just say this. The first driver, of course, is the massive shifts to sustainability, which is even though there's a bit of a tepid issues with respect to lithium and lithium carbonate and that part of the market, the solar shift to solar energy, I think that is not losing its momentum. It's continuing its momentum. If you ask me, is the market a problem? I don't think market demand is an issue. What we are certainly finding is a compression in pricing and compression in margin, which has affected us this year. And it is something which will play out. I don't think there's any shortcut to that. If you say that, is it going to play out in the short term? Yes. If it's going to play out in the medium term, I doubt it. And the reason for that main pressure on the margin and pricing is not coming in from the raw material side or input side. It is coming from the end product side, and mainly coming out of the issues in China, which is flowing into the rest of the world, and also issues in Europe. I think we've got two problems, which one is the China issue, where I think there's been huge surplus capacity, some of them uncompetitive, which should find its own way out of the market. And European capacities have been maintaining it's highly uncompetitive, and with the cost structure Europe has, I think they won't be able to compete. The difference between Europe and US is very simple. In US, we've got low energy costs, low variable costs. Maybe the fixed costs are very similar to Europe, but Europe has a combination of high fixed cost and high variable costs. So extremely difficult for chemical companies to survive unless they get access to lower energy, which they used to have pre-war in Europe. That has gone. Even if settlement of the war happens, I don't know how that energy game is going to play out, which is one of the reasons why Tata Chemicals has completely pivoted to value-added products in UK. You saw the announcement. We took a write-off of about 900 odd crores last year, and we are investing 600 crores in UK in pharmaceutical grade product and high grade food products in the same plant, because I think that's where the European plant and European investments make sense in terms of high grade value. Let me add one more piece to this. In addition to the shift in sustainability, which is what really would drive many of the chemical businesses right across, not just the businesses we are in, right across, because whether we talk about agriculture, agrochemicals, all of them are moving towards green and sustainable products. The key point which I want to say is that the kind of innovation I'm seeing in India, the kind of new technologies we're seeing there. I'm just back from the International Science Conference in Guwahati. Yesterday, I was in one of the IITs. The kind of solution and research groups which are running in this country are second to none. and pretty much on par with competing with the best in the world in US and in other parts of Asia. So I think we've got a game which is going now, and I think we should press ahead and look to making positive change. Next year, I think it all depends on how the first few months turn out, first quarter of the calendar turns out, whether a lot of these issues which we've been saying do get resolved, especially the two unfortunate wars and certainly the global supply chain, which is broken because of tensions, especially in the Red Sea and other parts of the world. Would they get corrected or not? We need to watch for that, and let's see how it progresses.
Okay. So let's start picking up the points which you've raised one by one. You are optimistic about US, you are confident about India. Where does China fit in? Because it is generally assumed that what China does decides the fate of chemical and chemical pricing in the short term. And there are two factors at play here right now, which is that the local Chinese demand, which could come back because of stimulus, and the import tariff, which could be at play once Donald Trump takes over.
Yeah. So on the import tariff issue, clearly, I think it's a tariff into the U.S. market, and I think the knock-on effect of that in the rest of the world obviously is going to be that the product is going to travel to other parts of the world. I don't see Chinese pulling back on their production, but it is going to be a tough call, and it will play out, Nikunj, in the medium term. In the short term, the world will be awash with more material coming all over. And each country will have to sort of then figure out what it wants to do with this material moving in. And it's clearly a problem. We are seeing, for example, in many chemicals, Russian material landing in India. The reason Russian material landing in India in the last 2 months is because of the sanctions put on Russia. So I really think the world must be, we must stay alert. The second piece is about how Chinese deal with their internal market. I am not so bullish on the Chinese internal market while they will inject some more positive enthusiasm there. But in the long run, their population is going to decline. It's already going to become like a country which is very similarly mirroring Japan. So we have a situation on hand where capacities have come on, and some of the old uneconomic capacities have to go out. It'll play out exactly the way it'll play out in Europe. Both these large markets are going to affect the rest of the world, and we need to sort of hope that their policy makers and the business owners there take the right decision.
A couple of follow-ups there, Mr. Mukundan. Hi, this is Anisha joining the conversation. You're talking about the Russian product landing in India, but if I have it right, ADD was imposed on some of these incoming products as well. Is that not helping enough, or any more policy push that you're recommending at this point of time?
See, I think government will continue to sort of protect domestic industry because it actually protects domestic supply chain in terms of resilience. But in the long run, we do believe that the market growth and the takeout of uncompetitive capacities is the right solution. We are not great believers in short-term solutions. What we do believe as a company is to be lowest cost, to survive through these periods, at the same time continue to invest in technology to keep our costs becoming more and more competitive. And at the same time, we know the rational position of where the pricing needs to be, and it'll reach those levels. So we are clearly, and these short-term measures are only to sort of alleviate the pain, and I'm sure they are going to help us. So that's where it is. But you know what? While the duty imposition against China and all may be positive, but on countries like strategic partners to Government of India, I think they would be very, very difficult. They would not want to put any specific country level duties on these countries. So I think we need to be balanced in our approach. But if sanctions get lifted and markets do open up, Russian energy costs are low, so they will be competitive in other parts of the world, and they'll start moving somewhere else. So really, the issue is which countries are producing at competitive cost and which countries are producing at uncompetitive cost. Europe is the top of the list, where capacities are to go out, and the next one would be uneconomic old capacities which are in China. That's it.
Okay, fair enough. And yes, we have to be very calibrated with our duties, because for the comments coming in from Donald Trump this morning as well, talking about the reciprocal tariffs, all of that will have a ripple effect. But you were talking about how the margin, depletion and pricing is something which will play out, and there's no easy way to get over it. But correct me if I'm wrong, I understand that there has been a further slip from the November pricing that we had seen in the month of December. There's a 3 to 5% slip in the prices. I think a month ago it was around 25 rupees per kg in India. What's the pricing right now of soda ash in the country? And as we move into January, February, March, what kind of pricing levels do you anticipate?
So let me first lay out the broad issue. This is not a pricing pressure coming in because of lack of demand. The demand exists, the market is growing. So I don't think it's a quantity problem. It is just that it's a competing material is landing at desperate prices, because as countries are trying to offload their inventory, especially out of China and out of even Turkey is finding it difficult to sell now in Europe, because European demand has fallen, in the sense that the domestic demand there has self-corrected, and they're growing very, very sluggishly. So we have the situation where Europe has to self-correct itself so that the Turkish material can move more towards Europe. And China has to address its internal issues. And once these two are done, I think the pricing will adjust itself. I think it's a bit of a fundamental point. Chemicals are basic products which go into other products. And being a basic product, we do depend a lot on the economics as they play out. And it's a ripple effect of two economies which are having two different problems. And our approach to this fundamentally is that these slippages may continue in the short term, but we'll address them. There's no issue of market demand, but in the medium term, they will correct themselves, because I think most people will have to face the music when if not in 6 months' time, 12 months' time or so.
Mukundan, morning. What is the impact, and how do you plan to address the potential risk when it comes to the near-term earnings? And that's largely on account of the ongoing global slowdown that we're seeing in soda ash demand.
Contrary to what you say, I think that there is only a slowdown in some of the pockets. Let me just highlight the pocket is on the lithium side, because there's a bit of a slowdown on the EV side, and also on some container glass. The issue fundamentally for us is that do we believe in a 3 to 4 year term, the electrification and the move towards renewable is a positive story, or is it a story which is going to grow at a sluggish pace? Our view is that this is a temporary blip. It is going to move forward, and clearly there are some issues which need to be addressed in several markets on their own, and I think they'll get addressed. In India, in US, I think these are trends which will continue to move forward. So we are fairly positive on that, and we are not going to back off. And our planning cycle, for example, when we say that we want to plan 1 million ton, it's a 24-30 month cycle. It is not a next quarter cycle. So we have no planning process while we do our annual plans, which is on the basis of what will be the pricing, what will be the market. In the long run, I think we do a planning cycle which is on the basis of medium term and long term. And there we believe that our cost structures, and also the fact that these are incremental capacities coming in most of the sites where the operating leverage is fairly high, we are very positive about, even at the current prices, to be making positive investments going forward.
What would be that aha moment for Tata Chemicals? While you're pivoting, you're doing a lot of interesting things like battery technology, moving into innovative research, nanotechnology, something you're trying your hand at. What would be that aha moment for Tata Motors? Tata Chemicals, I beg your pardon. Please pardon me, age is catching up. So what would be that aha moment for Tata Chemicals? I mean, in terms of some...
I think our approach on this is very clearly that we would continue to invest in core, continue to decarbonize our processes. We are very clear in UK, for example, will probably be negative net carbon in the core business. In US, we are completely pivoting to gas, and at some point, we've already announced our partnership with BWXT for putting SMRs, eight trains of micro nuclear reactors there. Hopefully they're commercial. We've got to go through a lot of hoops. Hopefully that progresses. In Kenya, we are going completely electric through electric calcination. There'll be no fuel, carbon fuel, which will be used in the process. And in India, we are using biomass increasingly, and our plan is by 2030, 30% biomass consumption will make us. So in the core, grow and decarbonize. That's the broad theme which we have, and remain competitive. And in terms of the new areas, we are fundamentally investing, continuing to double down on our two segments, which we have invested, one in Cuddalore and one in Nellore. Cuddalore plant, as I said, from 10,000 ton, we are taking it to 60,000 ton, adding another 50,000 ton capacity, which goes into tires. Again, a greening. It's about green tires, getting carbon out and getting silica in. I think that's what we are incorporating. And the product has taken longer time to get customer certification, but now we have no customer side issues at all. In terms of the other one in prebiotics, which is going to the food product, we are fairly big in food in terms of our food grade and pharma grade salt, food and pharma grade bicarbonate. This is adding to the portfolio which we have. And I think it's been a bit of a long run in terms of getting customer traction. But this year, we are very confident by the time we exit March, we'll be at 80% utilization of the plant. And we are going to be expanding the capacity there too, taking it to the rated capacity of 10,000 ton. So we are progressively increasing the share of what we call as cyclical versus non-cyclical product, which is currently in terms of EBITDA number, they are almost 50-50, but I think over a period of time, we want to make the percentage move, tilt more toward 10% higher towards non-cyclical. So that's really the approach we are taking. So we are growing through decarbonization, which gives us a right to stay in the business in the long run. And in the new products, we are expanding in a very structured way, and we are very positively inclined about the kind of customer response now we are getting after having established the technologies there. In terms of the energy business, which is where we are building, doing an R&D work, continue to do R&D work in materials which go into energy transition. That work continues. We will announce when we are ready. As of now, we are still working out what is the right approach and right pathway to enter.
Okay, point taken. That's the view coming in as far as Tata Chemicals is concerned. Thanks so much, Mr. Mukundan, for making time and patiently answering all our questions. Just wanted to deep dive because so much is happening in your industry at this point of time and so much to chat.
If you like this video, then like, share and subscribe to ET Now.